Is the luxury market dead? Are luxury stock not worth investing in anymore, or at least not in the short run? Why am I saying this? Well, because more recently Burberry Group did report their earnings, and it was a pretty bad report. Everything that could go wrong went wrong. There's a new CEO, sales are down, outlook doesn't look great, dividend has been suspended as well. So if you're seeing dividend yield at close to 8%, yeah, maybe right now because the stock is down so much, that's why you're getting that number, but the dividend is suspended. Now, Burberry has a market cap of $3.2 billion. Year to date, it's down 46%. Year over year, it's down 64%. Overall, since it went public, it's up 55%, but now we're back to prices not seen since 2010. Yes, you've heard that right. Right now, 2024, $9.36. We're back to prices not seen since 2010. Of course, you can buy it also on the London Stock Exchange. Since their all-time high, the stock is down over 70%. Why is that? Well, we're going to touch on all of it in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, Burberry. Right now, the analyst estimates are that for fiscal year 2025, sales taking a hit, down 8.3%, EPS taking a much bigger hit, down 30%. Moving to fiscal year 26 and 27, things are getting a little bit better. Sales growth of 7% for fiscal year 2026, EPS growing 4%, then sales growth only growing 2%, 2.5%, let's say, in fiscal year 2027, but EPS recovering quite nicely, growing close to 20%. Now, overall, what has been happening with Burberry? Well, you can clearly see revenue basically staying flat and actually coming down a little bit. Free cash flow definitely deteriorating, return on invested capital coming down as well, and the same for gross profit and net income. If we look at a couple of valuation metrics, so price to earnings, well, forward price to earnings, EV to EBITDA, price to sales, price to free cash flow, and then price earnings to growth. Yes, it's true on most, if not all of them, besides the price earnings to growth one, we are much lower than its 5-year mean. So you could say automatically, oh, the stock is cheap. Yes, the stock could be cheap, but a company right now is facing some headwinds. So while it might look cheap, there might be more pain ahead. That's why it's important not just to look at these types of metrics, right? The stock market metrics. Just looking at the PE doesn't tell you anything about a company. It might tell you sometimes that it's extremely expensive or extremely cheap. But then if you actually look at what the business is doing, what the commentary from the management is, what the industry, in this case the luxury industry, is doing, then it adds much more context. So something that might look cheap might actually be expensive, and something that is expensive might actually look cheap. Now, looking at Burberry, Richemont, Kering, LVMH, and Hermès, to name just a few, it's pretty clear that Burberry has been doing something wrong for quite a while. While all, if not most, of the other stocks and other companies have gone up quite a lot in the last 10 years, Burberry is actually down 21%. Of course, it did take a hit more recently, so previously it would have been up closer to, let's say, 50, and then even if we go a bit further back, it would have been up 100% or so. But clearly they are not doing as well as the other big giants in the luxury market. And this is an important point. I'll first go over a couple of extra stocks here. So LVMH, year performance for the stock, it's down close to 20%. The, let's say, downfall of the stock started back in May, June of this year. Then if we look at Richemont, year performance is basically flat, but here as well you could see that the stock is starting to come down. Maybe this was here a double top, which is usually bearish, but again, it's important to look at the whole story. Then looking at Hermès, the year performance, year-over-year performance, stock is still up 8%, but here as well, late May, starting June, the stock has started to come down. If we look at Swatch, of course, not really comparable apples to apples, Swatch to Hermès, but it's in the, let's say, watch jewelry industry segment, let's call it. The watch group year-over-year performance down 38.2%. So it's safe to say that overall the luxury segment is facing some headwinds. Now, More specifically, moving back to Burberry here, they have appointed a new CEO, Joshua Schulman, an American national, 52, he joins Burberry with a track record of driving transformative growth and value creation as CEO of global luxury, fashion, and retail businesses. Joshua was previously CEO of American fashion brands Michael Kors and Coach, where he also served as brand president. Prior to this, at Neiman Marcus Group, he was president of Bergdorf Goodman for 5 years. From 2007 to 2012, Joshua was CEO of Jimmy Choo in London. Earlier, Joshua was executive vice president worldwide merchandising and sales at Yves Saint Laurent and worldwide director women's ready-to-wear at Gucci. So he definitely knows a thing or two about the luxury fashion and retail market. Moving on to the results, the Q1 fiscal year 2025 results for Burberry. So comparable store sales decreased 21% year over year. They say here operating against a backdrop of slowing luxury demand with macroeconomic uncertainty in all key regions contributed to a sector slowdown. The weakness highlighted coming into fiscal year 2025 worsened through Q1. All regions declined outside of Japan. I would say that maybe the reason why Japan is showing such strength is because one, Japan is a very known market for luxury and fashion, and two, their currency is pretty weak, so probably a lot of people going to Japan, exchanging their currency for a weak yen and then buying the goods there. Currency was a 2% headwind this quarter, with retail revenue landing at £458 million. So if we look at the overall regions, 50% of fiscal year 2024 total retail sales comes from Asia Pacific. And so when that region is down quite a lot, right? Asia Pacific is down 23%. Of course, the overall business is going to take quite a big hit. That's not to say that the other regions are doing well. No, actually, Europe, Middle East, Asia here down 16%, Americas down 23%. Now, as for the fiscal year 2025 outlook, they say the following. The slowdown in trading we experienced in Q1 continued into July. If this trend were to continue through this quarter, we would expect to report an first half 2025 fiscal year operating loss and fiscal year 2025 operating profit to be below current consensus. As we navigate this period, we have decided to suspend dividend payment in respect of fiscal year 2025 in order to maintain a strong balance sheet and to strengthen our competitive position and underpin long-term growth. We expect the actions we are taking to start to deliver an improvement in our second half and to strengthen our competitive position and underpin long-term growth. Retail space to be broadly stable in fiscal year 2025, wholesale revenue to be down around 25% in the first half and down around 30% for fiscal year 2025. CapEx to be around £150 million, currency headwinds around £55 million revenue, and £20 million adjusted operating profit in the fiscal year 2025. So how are they going to turn this ship around? They've got some priorities in 2025, well, fiscal year 2025, and they've got some near-term actions as well. So the near-term actions here, they're reshaping marketing plans, launch of dedicated global outwear campaign in October, strong pipeline of product deliveries from July, including broader everyday luxury offer and more complete assortment across categories, refresh of website in progress, completed by end of August. Hopefully they contact Shopify, evolving ways of working to improve agility and efficiency, resetting cost base. And last one here, we expect actions to start to deliver an improvement in the second half of fiscal year 2025. So if you're looking to buy this stock, I would say you could be looking for signs already in the second half of fiscal year 2025 to actually see if these improvements are working. Now, I do want to read you a couple of things from the Swatch Group. Of course, I would have loved to show you something from lvmh, but they are yet to report. I think it's next week or the week after that. But Swatch here as well, you can see year over year, they're down, operating margin is down as well. Now, they say here with regard to the watches and jewelry, the huge reduction in demand for luxury goods in China, including Hong Kong and Macau, and in the Southeast Asian markets, which are heavily dependent on Chinese tourists, had a considerable negative impact on sales and results due to the strong presence of the group's brand in the region. China is a huge aspect of the luxury market overall. So I do expect all the other companies to face similar headwinds. Maybe not as big as Swatch, or Burberry, but I do expect them to take a hit because of that. Chinese economy is not doing well. They're not spending a lot of money on luxury goods. But the thing here, when talking about the luxury market, in my opinion, it is way better to focus on the giant. If you want to pick a luxury player, go for Hermès or lvmh. There's really no reason why you should be looking at the smaller players, because if there is, let's say, a struggle in that industry, well, the big ones will just become bigger and stronger. Now, on the flip side, they do say that in Europe, the group's own retail business achieved stable sales at the previous year's level. In the United States, they achieved the same record sales seen in the previous year. In Japan, which is one of the most important countries for luxury goods and the third largest export market for Swiss watches, achieved record sales with growth over 30%. Then, the last year, the group's retail activities exceeded the 45% mark of total sales in the watches and jewelry segment for the first time. Sales in the first half of 2024 were above those of the previous year in local currencies, except for China. Again, my opinion here is go with the huge one, go with the big players, go with Hermès or lvmh. And so, to conclude, this is basically the chart when you look at a Burberry. Stock is down 71% since it peaked right here at around, well, actually a year ago, May 2023. Actually, we're in July, so a bit more than a year ago. It peaked, it dropped 71% since, and I'm sure that from that point all the way down, people are saying, oh, it gets less expensive, it might even be cheap, but it keeps on dropping. So again, why it's important not to only look at forward PE, EV to EBITDA, stuff like that, but to actually study the business, study the industry. Because right now, like I said, we're back to levels not seen since 2010. Can they turn it around? Maybe, probably. I think it's a brand that has been around for quite a long time, so it would be a shame if they suddenly disappear. But for that, you will have to wait a quarter or two to actually see some results. Plus, it might also be out of their hands if the overall macroeconomic environment does not improve, if the Chinese economy does not improve, then yes, they are still going to take a hit. Maybe they can do stuff inside, like cutting the dividend, making better marketing strategies, spending wisely, then that will help definitely the bottom line. But overall, for the long-term strength of these types of companies, you need an economy that works well, you need people that make a lot of money, that want to spend on luxury goods. That's about it. And I reiterate yet again, this is why you go with the big ones, Hermès or lvmh. And if you want to bet on Richemont to be acquired by lvmh, maybe take a chance on that as well. So that will be it for this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.